Welcome back to the channel. Today we are breaking down how to analyze the financial performance of banks using a simple FPA approach. We'll look at profitability, efficiency, liquidity, leverage, and asset quality, which are the core ratios which tell you whether a bank is healthy, risky, or efficient. Let's get started. Why FPA in the bank is so different from other industries? Unlike most companies which plan around sales and operating costs, banks are fundamentally balance sheet driven businesses. Their performance depends on how effectively they manage the loans, deposits, capital, and risk. Bank FPA team don't just forecast the revenues, they model interest rates, credit losses, capital ratios, and stress scenarios. Even small changes in the economy or the interest rate can reshape the results, which makes planning far more complex and risk focused. Alright, let's start with the basics. Profitability. Basically, how well is the bank actually making money? First one is NIM, net interest margin. Think of it like this. Banks earn interest from the loans and they pay interest on the deposits. NIM shows the difference between the two. The formula is interest earned minus the interest paid divided by the total assets. If NIM goes up, great. The bank is managing its loan pricing and funding costs well. If NIM drops, it usually means deposit rates went up or the demand for loans is slowing down. Return on assets. This one tells you how much profit the bank makes for every pound of assets it holds. Higher ROA means the bank is using its assets efficiently. Then we have got return on equity. This shows how much profit the bank is generating from the shareholders' money. The formula is net profit divided by shareholders' equity. A higher return on equity looks good. Now let's talk about efficiency. Basically, is the bank running smoothly or wasting money? Efficiency ratio compares the bank's expenses to the income it generates. The lower the efficiency ratio, the better the performance. If this ratio shoots up, the bank is either spending too much or it's not earning enough. Next one is operating leverage. This shows how income is growing compared to the expenses. A positive operating leverage means income is rising faster than the cost, which is a healthy sign of performance. Negative leverage, that's usually an early warning of pressure. Alright, now we get into the safety checks, liquidity and capital. These ratios basically tell us, can the bank survive a rough patch? The first one is liquidity coverage ratio. This shows if the bank can handle a 30-day liquidity crisis. It compares the bank's high-quality liquid assets to its expected cash outflows. Higher LCR means a stronger liquidity. Usually, regulators want this above a minimum level. The next one is leverage ratio. This is super straightforward. It checks how much of the bank is funded by equity instead of debt. Higher ratio means the bank is safer. The next one is CET1 ratio. This compares the high quality capital to the bank's risk weighted assets. The higher the CET1 ratio, the stronger the bank's ability to absorb losses. If the economy slows or borrowers struggle to repay the loans, a bank with higher CET1 ratio can handle that pressure much better. Now let's look at asset quality. This tells us how risky the bank's loan book is. Gross NPA. Gross NPA shows the total bad loans as a percentage of total loans. Higher NPA means more credit risk. Net NPA shows what is left after the bank sets aside provisions. Lower net NPA means the bank is doing better job of covering the potential losses. Finally, PCR, provision coverage ratio. This tells you how much of the bad loans are actually covered by provisions. Higher PCR means the bank is well prepared for the loan losses. Low PCR can be risky during economic uncertainty. So, to sum it up, profitability ratios tells us how well the bank earns. Efficiency ratios show how well the bank control costs. Liquidity and leverage ratio reveal how safely the bank operates. And asset quality ratios tells us the real risk sitting inside the loan book. Together, these ratios help you understand the true financial health of any bank. Thank you for watching. I'll continue to share clear in-depth analysis and sector breakdowns in future videos. Make sure to subscribe and hit the like button. I'll see you in the next video.